A VA loan may offer 100% financing, but that does not automatically mean zero cash needed at closing. The way your purchase contract is structured can make a major difference. In this episode, I'll show you how a properly negotiated seller credit may help reduce the amount you need at closing. Hi, I'm Vance Scott with Approved Mortgage, a VA home loan educator serving Florida and Georgia with more than 25 years of lending experience. This is episode 2 of our VA Homebuyer Series, How to Negotiate Seller-Paid Closing Costs Without Weakening the Seller's Bottom Line. First, understand the goal. You may have no down payment, but there can still be closing costs, prepaid taxes and insurance, appraisal expenses, inspections, and other charges. A seller credit can help with allowable costs, but it must be written into the contract and approved by the lender. Here is a simplified example. A home is listed for $100,000. The seller wants to receive approximately $100,000 from the sale, and you would like the seller to contribute $4,000 toward your allowable closing costs. If you offer $100,000 and ask for a $4,000 credit, the seller may view the offer as approximately $96,000 before their other expenses. One possible strategy is to offer $104,000 and request a $4,000 seller credit, preserving approximately the seller's target while helping with your allowable costs. This is not free money or a guarantee. You are accepting a higher purchase price, potentially higher loan balance, payment, and interest. The appraisal is critical. If the VA appraisal supports only $100,000, the lender normally cannot simply finance the difference. You may need to renegotiate, reduce the credit, challenge the value with valid data, or bring additional funds. The contract must state the seller credit clearly. The credit cannot exceed actual allowable costs, and unused credit generally does not become cash back. Before submitting the offer, ask, what are the estimated allowable costs? What price is supported by comparable sales? And what net amount does the seller want? Your loan officer and real estate agent should communicate before the offer is written. There is another way to have eligible closing costs paid, a lender credit, for example. Suppose a $100,000 30-year fixed loan is available at 6% with a $4,000 seller credit. If the seller refuses, the lender may offer a $4,000 credit in exchange for a higher rate, such as 6.5%. In this illustration, principal and interest changes from $599.55 to $632.07, a difference of $32.52 per month. Taxes and insurance are not included. Rates, credits, eligibility, and terms vary, so compare the total long-term cost with your loan officer. A successful VA offer balances the seller's goals, the property's value, and your cash-to-close objective. Every transaction is different. This information is educational and not legal advice or a guarantee of financing. Follow for episode 3 and contact Approved Mortgage before you write your VA offer.